The market is currently closed, meaning we are looking at the final numbers from the latest session. NVIDIA stock wrapped up the last full trading session on Thursday, June 18, 2026, closing at exactly $210.69 per share. That represents a solid intraday jump of $6.04, or a positive market movement of 2.95% for the day. Volume was heavy as usual, with over 241 million shares changing hands, as buyers stepped in to push the price up from an intraday low of $206.50 all the way to a session high of $211.39. This push provided a welcome breather for investors who watched the stock drift down nearly 9% over the preceding weeks from its early June peaks. While the headline numbers show a strong single-day rebound, the real action is happening beneath the surface in the institutional credit markets. Just days ago, NVIDIA completed a massive $25 billion bond offering that quietly drew a staggering $85 billion in total investor demand. Think about that for a second. Large institutional players were willing to lend this company nearly 4 times the capital it actually asked for. While retail investors using their favorite online stock trading platform were panic selling over short-term tech sector rotations, the smartest debt investors on Wall Street were practically kicking down the door to hand over their cash. This tells us that while the stock equity chart looks jagged and unstable, the institutional backbone supporting this company is stronger than it has ever been. The general consensus you hear on mainstream investing sites is pretty simple. Most people look at Apple stock or NVIDIA stock and assume that since the data center boom has been running hot for years, the easy gains are completely gone. The narrative out there is that the market has fully priced in the Blackwell architecture and that any further upside requires a massive stretch in valuation. People look at the 52-week high of $236.54 and think the stock is bumping against a permanent ceiling. They assume that escalating competition from cloud providers building their own custom silicon will inevitably eat away at the company's margins and drag down the net profit. But that common belief completely misses the point of how deeply entrenched this ecosystem actually is. The reality is that the hardware is no longer the sole proprietary advantage. The true moat is the software environment that locks developers into the specific hardware architecture. When you look at platforms like Interactive Brokers or SoFi Invest, you see massive daily volumes of capital moving based on hardware shipment numbers, but the institutional whales are focusing on software ecosystem retention. The market is pricing this company like a cyclical hardware manufacturer, whereas it is actually operating like an infrastructure monopoly with recurring architectural dominance. If you track the recent daily swings, you can see a fascinating tug-of-war on the charts. After peaking near $237 back in mid-May following a massive quarterly report, the stock entered a period of steady compression. It fell below its short-term 15-minute moving averages, hitting a minor floor around $202.50. Retail platforms like the Robinhood app saw a wave of short-term liquidations as traders grew nervous about tech sector momentum and macroeconomic pressures from the Federal Reserve. Every time the price tried to reclaim its 50-period moving average of $206.34, overhead supply would push it back down. Yet the moment it dipped toward 200, institutional buying via advanced trading desks systematically absorbed the float. This brings us to the recent earnings reaction that set the stage for where we are right now. In late May, the company delivered a mind-boggling quarterly revenue figure of $81.6 billion, which was an 85% increase year over year. Think about the sheer scale required for a company of this size to nearly double its top line in 12 months. Earnings per share came in at $1.98, handily beating the Wall Street consensus of $1.76. Alongside those numbers, the board approved a massive $80 billion share repurchase authorization. On a standard self-investing platform or a basic individual brokerage account, that kind of report looks like an automatic trigger for a stock to skyrocket. Instead, the price initially dropped because short-term traders sold the news, creating a massive divergence between spectacular corporate reality and muted stock performance. The trading desk data shows that institutional accumulation has been quietly rising despite the choppy price action. When you analyze fund flows across major platforms like Fidelity Wealth Management or individual retirement portfolios, you find that long-term managers are treating these sub-$210 levels as a gift. The company's trailing price-to-earnings ratio has actually compressed down to around 32, which is remarkably reasonable compared to historical peaks when it traded well over 60 times earnings. This compression happened because the company's actual earnings grew faster than the stock price, which is exactly what a value-conscious investor wants to see before putting capital to work online. Comment below how many shares of NVIDIA stock you currently hold in your portfolio right now. I'm curious to see if you are actively buying this recent dip or just holding on to your original position. To truly understand why the institutional crowd is so unbothered by recent volatility, we have to look at what this business actually does at its core. This is not just a company that stamps out graphics chips for gaming PCs anymore, though that legacy business still ticks along in the background. The core business model is centered on providing the entire foundational layer for accelerated computing. They design the complex architecture, write the proprietary software libraries, and build the high-speed networking systems that allow thousands of graphics processors to act as a single massive supercomputer. Their products are the standard infrastructure for every major cloud provider, national research lab, and enterprise data center on Earth. This architectural dominance was reinforced just weeks ago at the Computex event in Taipei, where the company revealed its new consumer PC architecture called the RTX Spark. This new chip combines an advanced processor architecture with their dominant graphics architecture on a single piece of silicon. This move marks a direct push into the laptop and personal computing space, putting them in direct competition with legacy computer hardware giants, and even matching up against consumer ecosystems like Apple stock. By diversifying away from pure data center dependence and anchoring their technology inside the consumer devices people use every single day, they are opening up a completely separate avenue of recurring commercial demand. When we look at the future outlook, the tension between market expectations and operational reality will continue to dictate where the stock goes next. The bear case, often highlighted on various investing sites, suggests that capital expenditure from the big tech companies will eventually slow down, causing a massive drop-off in orders. There is a fear that the market is overestimating how much infrastructure the world actually needs. If those capital expenditure budgets get cut, a high-flying stock can get punished severely on the public exchanges. However, the upside opportunities look far more compelling when you look at the upcoming corporate catalysts. The company has its annual meeting of stockholders coming up on June 24, which always serves as a platform for updated strategic guidance. Furthermore, the massive $80 billion stock buyback program provides a constant structural bid beneath the share price, as the corporate treasury can systematically retire shares whenever the market experiences a macro-driven sell-off. If the company hits its guided targets for the next quarter, the current valuation of 32 times earnings will look incredibly cheap in hindsight. For individual investors managing their own capital through tools like Schwab Intelligent Portfolios or a standard online investing platform, navigating this stock requires ignoring the daily noise and focusing on the structural trends. The short-term chart might look like a battleground, with support levels at $202.50 and resistance bands sitting right around $215, but the underlying cash generation tells a completely different story. The company is generating tens of billions of dollars in free cash flow every single quarter, giving it the balance sheet strength to fund its own development, buy back its own shares, and clear out any competitors before they can even get a foothold. When we weigh the expectations against the reality, the conclusion becomes clear. The market expects structural deceleration and margin compression due to rising competitive threats. The reality, as evidenced by the massive institutional demand for their debt and the sheer scale of their software lock-in, is that this business operates more like an essential utility for the modern computational world. While short-term traders will continue to bicker over daily percentage swings on their mobile screens, the underlying business is fundamentally outperforming the narrative. The recent pullback from the all-time highs has not weakened the corporate foundation. It simply brought the stock price back down to a level where the underlying valuation is once again supported by real tangible cash flow. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.